topic again is Social Security, and my goal really is to make it simple. So we're going to keep it fairly high level. And as Chris said, if you have something really unique and specific to you, you can certainly pose the question, but it might make sense for us to talk offline. I also have software that I use where I can plug in all different kinds of scenarios based on claiming ages and if you had been married or now divorced and so on and so forth. But it's really cool and it plugs in all the different parameters and it allows me to look at all the different claiming strategies. So that is certainly something that is available to you. We'll talk a little bit more about that, but it's a wonderful tool that I have the ability to use. So let me tell you a little bit about me and a little bit about us as an organization. Social Security is one of the topics. It's not moving here. Let's see. Okay, so my screen doesn't go up or down. So what should I be doing here? So here's up, here's down. There we go. Just didn't press hard enough. Okay, there we go. I'll tell you, I'm still getting used to Zoom, and all you can do sometimes is just chuckle. But what I will tell you is behind the scenes here is Lauren Kent, and she's part of my team. And it's wonderful to have somebody a little bit younger than myself who is able to help us with all this technology stuff. So here we go. In front of you is a picture of our team here at Cornerstone Retirement Partners. So some of you might know us by our former name. We just have rebranded ourselves. We used to be known as Ron Corser and Associates. So there I am in the middle with a white dress. That's Nancy Corser. Next to me is Ron Corser. So my husband started the firm probably about 20 years ago. He then went with the name Ron Corser and Associates. And then to the right of me, the other gentleman there, he is slated to buy out the wealth portion of our practice. So what we do is we connect the health insurance side with the wealth planning side. Social Security kind of falls in the middle there. So I've been the one that over the last 10 plus years has helped actually both the advisors with the Social Security part. But my claim to fame is Medicare. Some of you I've helped with your Medicare. I help with any individual insurance under the age of 65. I help with Social Security planning, and I also help with long-term care planning. So I'm very much the health side of the business with a little bit of expertise here in Social Security because that's an important component to your retirement planning. On the very far left is Lauren. Next to Lauren is Lindsay. She's working with Ron and Nolan. My sister is right next to me. She's also part of our team. And to the far right is Beth. So if you were to call in, she's the one that answers the phone. And again, we've been around for almost 20 years, and we're kind of just a small boutique financial planning, insurance planning kind of firm here to help you in any way. So we're very much about making sure that you know about any kind of missing fact or piece of information that we know could be significant in you making decisions about your Social Security. We don't like surprises. I'm sure most of you feel the very same way. So we try to head them off at the pass. We've been around long enough to have a pretty good flavor for where people often will say, gee, I didn't know that. Wow, that really could make a difference. So we try to bring those to your attention. And again, part of our planning process does include Social Security. For those of you that might have financial advisors, make sure that they're helping you with the Social Security. It should be part of their practice so that you know if you haven't claimed, what might be the best claiming option for you. And certainly you're going to be able to take away some of the information from the presentation and go back to your own advisor and inquire about that too. So we want you to be informed. We want you to be educated. Social Security clearly is an important source of retirement income. It will coordinate with the rest of your income plan. So when people come in and they talk to our financial advisors, Ron and Nolan, they're always talking about their 401k or their IRAs, but they're also spending a lot of time on their Social Security, because really until you reach the age of claiming, you don't think so much about your Social Security. You're working, you're collecting assets, you're managing your money, but in the meantime, they're taking Social Security from your paycheck. And as you get closer to 62, which is the first age that you can claim, is when people really start thinking about, wow, I have been contributing over these years. I wonder what this really means to me, and when is it that I would like to take it? So it can't be looked at as a separate entity. It needs to be coordinated with your entire income plan. And certainly timing is a very important element. If you claim early, which is before your full retirement age, you will always get less. If you wait until your full retirement age, and it will depend on what year you were born in as to when that actually transpires, you will get 100% of your benefit. And if you decide, no, I'm going to wait as long as I can, you will get more, and the maximum age is going to be 70. Social Security is a steady, reliable source of income. You know how much going into it you're going to get. On top of that, every year, hopefully there's some type of cost of living adjustment. In the last couple of years, it's been somewhat minor. In the past, 5-10 years ago, they were pretty substantial. I think this last year's COLA was 1.2%. So it's a steady source of reliable income coming from the government. It's a lifetime income. It's inflation adjusted. That would be the COLA. And if you are married, have been married, you also have access to survivor benefits. So we'll talk about those in a little bit more detail. Tonight, we're going to talk about when you should apply for Social Security and what the impact is of when you do apply. How do they determine your benefits? What those tax implications would be by collecting Social Security. Will it be enough to live on in retirement? And how can you maximize your Social Security benefits? It is an 80-year-old program. It was put into place by Franklin Delano Roosevelt during the Great Depression. It was originally designed to help senior citizens escape poverty in their old age. And at that time, many people were retiring at 65. And that's when it was first available, when it was first introduced. That was the full retirement age, 65. At the same time, they also determined that when they made the benefit available, they also said to the wife at that point, look, you're home, you're taking care of the kids, your husband is working. We're going to make it possible if you never work and you don't pay into the system, you're going to get a spousal benefit. So that spousal benefit was put into place long ago with the idea being, let's make sure that the person who wasn't working and taking care of the family also is entitled to some type of benefit. Social Security, at the time it was put in place, was never intended to be the only source of income. There were a lot more pensions at that time that were available. Those are becoming fewer and fewer, but they had CDs and they had other sources of income, life insurance, investments, that type of thing. 401ks were not around until later. Eligibility today says you have to be working in a Social Security covered job where they're taking the Social Security tax from your check for at least 10 years. Kind of an interesting comparison. I'm not going to go through side by side, but when you compare 1935 to today, one of the huge factors is life expectancy. So when people collected back in 1935, some of them never even collected because they never even made it to age 65. And those that did, they didn't live well past 70 or 75 years in age. Today, we certainly see the average life expectancy of 78, but wow, we see people well into their 90s and even 100 collecting their Social Security benefit. So back in 1935, they generally Well, some did not live, but they probably at that point paid into it, collected for a period of time, and then they passed away. What we actually have today, which is a bit of a problem, is we have fewer people working, contributing into Social Security, and by the same token, we have people living longer. So the person that worked for the 35 or 40 years, they contributed X number of dollars, they're outliving the money that they actually put into their account. And that's what's really taxing Social Security right now, because many people living into their 80s or 90s, the government is saying you might have paid X, but we're actually paying Y, because that was our commitment to you, is that it would be with you for your lifetime. And when you pass away, then that benefit goes away. So today, the average retiree receives about $1,523 a month in benefits. When you compare to 1940, the retiree today receives about 12 more years of Social Security benefits. Again, it speaks to that age differential with people living much longer today than ever before. 90% of those people that are 65 or older do receive their Social Security income benefits. In fact, many people claim at age 62. Some of those same people I've talked to over time have said, I wish I would have waited a little longer. I wish I would have known what the impact would be by claiming. But there are various reasons, certainly very valid, as to why people claim at age 62 versus waiting. In 2021, the maximum amount paid out for a Social Security benefit is $3,148 a month. So you can see the average is about $1,500, and yet there are some people that are receiving over $3,000 a month. So Social Security is truly a pay-as-you-go system. The money gets deposited into this huge trust fund by today's workers. But the retirees of today are living much longer than the monies that were actually deposited into that account. So at the end of the presentation, you'll see a few of the proposals that have been floated over the years in terms of trying to get this more in line with what right now is being quoted as, by the year 2034, the system isn't going to have enough to pay 100% to the current beneficiaries. So hopefully with the current administration, they're going to tackle this and make some inroads so that there's more of a promise long-term that we can count on. So sources of income, I kind of mentioned it previously. In terms of going forward, once you retire, these are the resources that you are drawing upon in addition to Social Security. So this is an illustration of you not outliving your benefit, but also showing you with a $2,000 example, the impact of the 2.6% COLA, and then how much money really is deposited into your account over your lifetime. So if your monthly benefit was $2,000, in 10 years, that amount would have grown to $301,141. Those are the dollars that they would have paid you month after month after month over the course of 10 years with the assumption of an annual cost of living adjustment. So in 20 years, it looks like $659. And if you live 30 years beyond when you claimed, you'll have a bucket of money that over the course of the time the government has paid to you of $1.1 million. And it's highly unlikely that anybody has worked and paid $1.1 million worth of Social Security taxes. The eligibility, as mentioned earlier, you must have at least 10 years or 4 credits per year that are accumulated and given to you. You have to have that Social Security job where those dollars are deposited, and that allows you this basic benefit at the age 62. The benefits themselves, in terms of the dollars that are determined, are a function of the following: how much you earned over your working lifetime. Many of us started at age 16 or 17 or 18. And it's kind of interesting when you look at your record, you can see every year it shows what you made. And it's pretty amazing when you look back 30 years and you think, wow, I started at age 18 or 20 with my first job, and you only made $9,000. So you can see what the cost of living has done and how things have certainly changed in terms of just your job and how well you've done and so on and so forth. So certainly the age at which you apply, 62 being the youngest, 70 being the oldest, your marital status is going to come into play, whether you're married, single, or divorced, or even widowed. How well you use the rules to maximize your benefits is going to determine the overall benefit that you receive. Now, honestly, there's not as many rules as we used to be able to use in years past. I'll touch briefly upon those. One of the biggies that is no longer available is called file and suspend. So that rule went away several years ago, and it only applies to people. Actually, there were two. File and suspend is completely gone. File restricted is the one that is still available, but it's only available to people that were born prior to January 1st of 1954. I'll talk about that in a moment. But some of the really cool ways to maximize your benefits, the government said, oh, we really never intended for somebody to be able to file, take part of their benefit, suspend it, and then be able to grow that benefit. So that's gone. In terms of the actual calculation itself, I'm not going to go into great detail. If you ever come and see me and you say, you know what, I'd like to really see the logic behind this and the numbers and so on, I'd be happy to show you. But in summary, at age 62, they are going to tally up your earnings, and then they're going to do some indexing for inflation. And then they have some other factors that they're going to apply, which becomes known as your average index monthly earning. And then they have these bend points, which is again part of their formula and their calculation. And before you know it, they come up with a full retirement amount. And that's what you actually see on your statement. That's what's in the right-hand corner of your Social Security statement if you haven't started collecting. But the way they go about doing it is a little bit challenging and a little bit, I don't know if I'd even say it's sophisticated, but there was a logic, and I'm sure the actuaries said this is what you need to look at in terms of forecasting and so on. Certainly, the more you make, the more you're going to have in terms of your full retirement amount. And you can still contribute and have an impact on your full retirement amount when you work beyond age 62. So for those of you that are working till age 70 or 75, I've even had people work till 80, okay? If you're still paying into Social Security, they're still going to be putting that into the formula. So if you make $1 million 1 year, yeah, there are thresholds, but you still can bump it up. Benefit is increased each year by the cost of living adjustments, and those are called cost of living or COLAs. So these are some important milestones, and this is where we will help people begin that journey or that planning aspect of things. At age 62, that's the earliest you can collect your Social Security. You will take a haircut or a reduction of 25%. At age 65, and this can trip people up, this is the age that you want to think about whether you want to take your Medicare or not. You would call me if you would like, and I'd be happy to walk you through it. If you were working, you might not need to sign up. If you're not working and you're on the Affordable Care Act, I would recommend that you do sign up. Sometimes people don't have health insurance, but now they're 65 and they qualify for their Medicare. They also should sign up for their Medicare. So you generally get bombarded about a year in advance, and all these folks have all the answers. But if you want to meet face-to-face, and that I think is one of the things that does make us different, is we will meet face-to-face. We adhere to all the social distancing and the mask, and we've gotten our COVID vaccines and so on and so forth. But We can also do Zoom, and we can certainly do a phone call. But when you get ready to turn 65, probably about 6 months beforehand, you really need to think about, am I going to take it? Why am I going to take it? That's the appropriate response. But going back to Social Security, at age 67 or somewhere in between, up to age 67 becomes people's full retirement age. So people that were born in 1954 or prior, their full retirement age is 66. People that were born in years subsequent, so 1955, the next year, they take the age 66 and they add 2 months. A person that's born in 1956, they're going to add 4 months. The person that's born in 57, so on and so forth. So it's in 2-month increments. The maximum is age 70. If you claim your Social Security benefit prior to age 65, this is important to know for those people in that age category, you will automatically be signed up for Medicare. So sometimes this comes as a surprise to people. They say, I'm going to take my Medicare, I turned it on, but maybe they're even working part-time, or they're on their spouse's group health insurance plan. They've turned on their Social Security, they're claiming that portion of their benefit, and all of a sudden they get their Medicare card in the mail and they're like, well, what do I do with it? Again, you need to determine whether or not you want to actually keep your Medicare Part B, or you want to return your card, because there is a premium associated with Part B. So the point here is, if you are collecting at age 62, once you turn 65, they have your name and number. They're going to send you a card. You need to decide whether you're going to keep Part A and or B. Secondly, if you want your Medicare to start at age 65 and you're not on Social Security, as a side note, again, we're talking about Social Security, but you actually have to apply online for your Medicare. It's not automatic. So that's just the difference between being on Social Security, you get your card, not on Social Security, but want your Medicare, you have to do it online. Again, we can help with that. And for those that might still be working, you absolutely cannot contribute to an HSA, which is a health savings account. Typically, it's a high deductible where you're contributing and often the employer is contributing or matching. You cannot be on any portion of Medicare. So you can't be on A and you cannot be on A and B. You will face the possibility of a penalty. So some people, they don't know that, or their HR department has not made that clear. So I just want you to give that some consideration. Cannot be on any part of A or B and continue to contribute to an HSA. You can use all the monies for the way that they are intended to be spent, but you cannot contribute, and your employer should not be contributing. So here's a little terminology. Chris sent to you yesterday or maybe the day before the handouts that will be important and helpful in referring back after this presentation. So keep that in mind. I did have a couple sheets there that you could keep notes on, and it also spoke to the terminology because it can be very confusing when you read articles or when you're talking to your financial advisor, or even me sometimes. I'll kind of slip up and I'll start using those acronyms and you're like, wait a minute, what do they mean? So your FRA stands for your full retirement age. It's either between 66 and 67 or someplace in between there based on the year that you were born. The PIA stands for the primary insurance amount. This is the amount that's in the right-hand corner if you're still getting a statement or online and you download it. And this is 100% of the monies due you at your full retirement age. A DRC stands for delayed retirement credit. A delayed retirement credit occurs after your full retirement age if you've decided not to claim. And on average, it represents 8% in terms of an adjustment associated with your primary insurance amount. So some people tell me, you know, I'm leaving it in there. I don't need the money. 8% is pretty good right now. So they say, I'm going to let it grow. It's a guaranteed 8% between their full retirement age, and age 70. So every year it grows 8%, 8%, 8%. So if your full retirement age was 66, you can delay it till 70. It's going to grow 32%, 8 for 4 years. The COL stands for cost of living adjustment. I mentioned it earlier. It's been kind of meager the last couple of years. Hopefully that'll change. And then we basically have 3 different kinds of benefits that can be claimed. And it's important that you use the terminology appropriate here, because if you say, I want my spousal benefit and you're married, you'll get that. But if you really meant your individual benefit, you're going to get your spousal benefit. So you need to make sure you understand the differences and use it appropriately. Your individual benefit is the benefit that you earned all the years that you've been working or still are working and paid into the system. That's the one in the right-hand corner. That's your individual benefit. The spousal benefit, as I said years and years ago, the spouse who didn't work, he or she is entitled to 50% of the individual benefit at their full retirement age. And we're going to go into that in a little bit more detail, because some people think, oh, well, I'll just turn it on at 62. Why did I not get 50%? Well, you didn't wait till your full retirement age. That's why it's helpful to understand the terminology. But the spousal benefit will always be 50% or something less, depending upon when the person turned it on. So some people have a spousal benefit and an individual benefit, but you can't have them both at the same time. And I'll speak to that a little bit later. The survivor benefit would be an example of a married couple, or even someone that was married and now divorced and had been married for 10 years, and the individual has passed away. You might look at it and say, you know, the survivor benefit might be more than my individual benefit. I might be able to trade my individual benefit for my survivor benefit, okay? And you'll see how that plays out as well. So you're always kind of looking at this saying, what makes the most sense? Where am I going to get the most money? And when can I actually do some of these things in terms of the timing and not take a haircut to some of this? Here were the years of birth. I couldn't remember them all as we were kind of going through 1954 through 1960, but it's at age 67 for those people that were born in 1960 or later. That is their full retirement age. One of the plans on the docket is to change that and increase it. So you might see down the road a 68. And it might be for people that were born in 1980. I'm just making this up, but I wouldn't be surprised that this would be one of the areas that they would tackle and say, look, for those people born later, you're going to have to wait later. So this would be one approach that they could take. But if you're in that category right there, that you can see that if you were born in 59, your 100% is going to be, I have to wait for 66, and then I got to count 10 months for me to get 100%. So when should you take your Social Security benefit? It really is going to be an individual decision. Again, your financial advisor might have a role to play, but if not, you're asking yourself questions like, do I need the money to live on? So if you do, then I think it's a pretty straightforward answer. You're going to change and trade a paycheck for your Social Security check. So you need money to live on, you're going to turn it on. Are you in poor health? People will tell me, you know, my health is poor, or I've already have this diagnosis, or my family history tends to lean in this particular direction, or I've seen a family member with an inherited situation. You might want to turn it on. You might not want to wait till 66 or 67 in terms of your full retirement. So it's a very personal decision based on what kind of money do you need to live on and how long do you think you're going to last. Your life expectancy. Certainly, if you think you're going to have a long life and you've got other resources, why not turn it on at age 70 and collect that 32%? Some people prefer to take the money when they can whether that's early or whether they wait till their full retirement age and they would prefer to take the benefits and invest them elsewhere and do other things with them, okay? So it really all depends, but knowing when and how much and the impact will certainly have a role to play here. This shows you what happens if you claim early. So if you're in the I can collect at 66 years old, born prior to 1954, or prior to 1955, I should actually say, it's 54 and beyond. At age 62, you would have taken a 25% adjustment, haircut, as I would say, or reduction, if you will, and you can see the increments there. If you are 67 in terms of your full retirement age and decide to pull the trigger at age 62, you're going to pull it early. You're going to take a 30% reduction in your overall. And it's simple math. It really is. So if your benefit was $2,000, you would take $2,000 times 70%. And that's what you're going to take. And the rest of it you've left on the table because you've decided you cannot or don't want to wait until your full retirement age. Again, a very personal decision, but you can see the impact of that. So if you file before your full retirement age, you can kind of see the numbers here, but they play out in terms of dollars and cents to the right. We've got if the person's primary insurance amount was $2,230, they knew that going into it, what does that mean at age 62? Well, you can see that it represents over $500 worth of a difference there. So you can do the math and you can kind of figure out what's what there in terms of how much money you would be giving up as a result of filing early. And again, that's that software that I talked to you about earlier. If you say, you know what, I'd like some help with this, let's do some what if scenarios. Here are my numbers. Show me what happens if I claim at 64. Show me what happens if both of us, my husband, my wife, we claim at 63. He claims at 70. We can do those scenarios for you. Again, when you apply at full retirement, you get 100%. Now, here's the other beautiful thing, and I ran into this last night. I had a gal, she was almost 68. She wants to retire. And she said, now, remind me again, do I have that earnings limitation? No. When you turn full retirement age, and in her case yesterday, she's 66, she can make as much money as she wants and continue to work. The only consideration that everybody and anybody would have is it's possible that your Social Security that you receive will be subject to some type of taxation. So there's really two scenarios here. This scenario applies to the person who's working. So if you are still working, and you are not full retirement age, you may have to pay them some money back. And I'll show you that in the next page here. But the key here is if you wait till your full retirement age, you get to keep 100%. You can do with it as you see fit, and you can keep working. You're still going to pay into Social Security. You might even be able to increase that record that we talked about because they take the top 35 earning years to calculate your full retirement age, okay, or your full retirement amount, I should say. So that's the beauty of waiting until your full retirement, and maybe you still want to work. If you apply after full retirement, we already kind of spoke to that. It just shows you the benefits of the 8% accrual. So the person that waits till age 70 that could have filed at age 66, there's that 32%. The person whose full retirement age is 67, there's 24%. So in between, it's some type of scenario there, again, dependent upon where you fall, but you can certainly see that you're going to collect almost 8%. Every month that you wait to claim, then you will accumulate that 8%, and it actually boils down to 0.67% more per month. So sometimes people say, you told me about the annual figure, it's 8, but what is the monthly figure? And again, I say the software that I have, which I can print right out for you, kind of shows you this right in front of you so you can see exactly, gee, if I decide to turn it on 3 months before my full retirement age, how much did I really give up? So that was kind of the point and purpose of this here. And again, there's the example using the 2,230. So this particular person here said I could claim at 66, I decided that I was going to wait till age 70. They took their benefit from $22.30 a month and they took it all the way up to almost $3,000. So it definitely makes a difference. So here's the scenario as it pertains to the person that's working. So it works like this. And again, I've got brochures. We can walk through it in more detail, but very high level, it's like this. If you apply for your Social Security before your full retirement age and you work, so you're still working, you've not called it quits, you are going to forego $1 in benefits that you lose for every $2 that you go over the threshold. So the threshold for someone who's below the age of 66 or 67, but 66 in our example here. The threshold this year is you cannot exceed $18,960 in earnings. Now, this tends to be your W-2 kind of earning. So here's my example. The person said, I'm going to turn it on. I am entitled to a $600 a month benefit. When they called Social Security or where they were online, because you can file for your benefits early at full retirement age or even at age 70, you can do it all online. And that's really where they're pushing you. They want you to set up a Social Security account. They've made it fairly easy. Again, we do help with that if you would like in terms of filing online. The Social Security office is still closed. They will allow you on a special appointment basis only to go see them. Otherwise, they make you make a phone appointment. And again, we are certainly a resource for some of that. And they have good instructions online as well in terms of what you can do and what you can't do. If it's fairly straightforward, of which this is, the person said, I want to claim. They said, I'm entitled to $600. They also said, you know, based on my earnings of the prior years and what I think I'm gonna make another $23,920. Well, you can see they just went over that threshold. So what the government does on the front end is they say, okay, it looks like you're gonna go over about $5,000 because they're gonna ask you these questions. They will not start paying this person until June. So what they basically did is they said from January through May, you're not gonna get paid because we're gonna take the piece that you went over and then we will start paying you your $600. So they didn't reduce the $600. They just said, we're just not going to start it quite yet. The next scenario is going to show you. We're working on the down button again here. So it didn't work. Isn't that interesting? So here's down.
Go up.
Go up. Nope. Neither are working. So try the arrow keys. Down.
No,
Try these arrow keys. Isn't that interesting? What else can you say, right? So let's see. So if I put this flipper out there and I go back, okay, so I just apparently had to wake it up. Maybe that's what happened there. So thank you. I'll pull myself back there. Okay, here we go. So here's another example. Now, what's different here is the person that becomes fully retired in terms of their age has a different scenario for the year that they retire. So in other words, if your full retirement age is this year and you hadn't turned on your benefits, you have a threshold of $50,520, not the $18,000 for the one that was below that age. That person was 62. This person says, I'm entitled to my full retirement. I want to know how this works because I am actually going to call it quits. So their full retirement age, their full retirement amount, let's say in November of this year is the same 600, different person, but same 600. They estimate their annual earnings is going to be slightly over the threshold of the 50,000, not a lot, but a little bit, okay? So their overage there is going to be a little over $1,000, okay? So in this particular example, it's a little different. So what they did is they said, you owe us $1 for every 3 that you go over. So if you divide the overage by 3, the government said, we're taking back our third. So there's their $340. But in the month of January, because that's when this person wanted to turn on their benefits, okay, they will get their $600. But the government is going to withhold $340. And they will actually pay them the $340 and not until the next January. So they pull it out, they take their money, and they start paying the $600, but they will give you back the $340. The person worked from January through October. They were no longer working in November, December, and January. A little confusing, again, can walk you through your specific scenario. One other rule, and that is given the very first year that you retire, okay? So here's another example. A full Social Security check for any whole month that you're retired is issued. They consider you retired as long as your monthly earnings are less than $1,580. So what did they do? They took that $18,000 number and they divided by 12. That's how they came up with the 1580. And again, some of the information that I provided to you in hard copy, it goes into more detail to explain these. But my example here says the person says, I'm calling it quits right around Halloween. They want their monthly benefit. They've got online or they've called Social Security and made an appointment. They certainly can work through it that way, and they're very good about helping you. But this person also said, you know, I might want to work part-time here a little bit. So the key here is they're going to get their earnings based on the month, as long as it's less than the 1580, as long as their part-time earnings here are below the 1580, the government doesn't make any adjustments. It's not the one for $2, and it certainly isn't the one for $3, because that's when you were at your full retirement age. But the next year, if this person keeps working, they're going to have to make sure they stay below the $18,000 flex, the $18,000 threshold. But the first year they make an exception for in terms of how they pay you. And then the next year, the assumption is you're not at full retirement age, then they're going to look at that $18,000. And then in your year of the full retirement age, they're going to look at the $50,000. And once you hit your full retirement age, they're not looking at any of those numbers. So if you apply for Social Security after your full retirement age, again, we've already spoke to that, so I'm going to skip that. Talk about the spousal benefit. We said it's 50% of the primary insurance amount of the other spouse. So if your spouse has a primary insurance amount of $2,000 and you are the other spouse and your amount is only $500, you would be entitled to taking the 50% of $2,000 or $1,000, but only at your own full retirement age, okay? So that's how Social Security is going to look at it. Now, if your spouse had $2,000 and your individual benefit was $1,500, you're not going to get anything. You've got your $1,500, because if you take half of the $2,000, obviously it's $1,000. Well, that's less than your own benefit. So then the spousal benefit doesn't count. So you really have to do the math to determine whether or not this is even going to be something that works for you. So if your spouse has filed for a retirement benefit, it is possible for the other spouse to file, okay? They are going to look at the application and they're going to determine the ages of the people and where they actually fall. So in other words, my point is this, it all boils down to those ages again. If the person is a spouse and they want half, they have to wait till 66 or someplace between 66 and 67. If the person says, I still want my benefit and I want it at 62, the point here is that the spouse with the higher earnings has to already have claimed his or her benefit to make it possible for the other spouse to claim their benefit. And what Social Security actually does is they say, okay, the person is not they're not full retirement age. So we're going to give them an adjustment based on that chart that we saw, okay? And then they're going to make the appropriate adjustment here. So I do have an example here in a minute too. So keep in mind that Social Security does not allow delayed retirement credits beyond the full retirement age for a spouse. So the critical point is this: if you are the higher earning spouse, the longer you wait to claim, the more you make it possible for the other spouse to claim their survivor benefit at a higher amount. That one is the higher amount. But there is no point in looking at the spousal benefit and saying, you know, I'll wait till I'm 70. But if you're the spouse who says, okay, I want 50%, you're not going to get 50% of the 70 value. You're only going to get 50% of the person's full retirement age value. So that's the point here of spousal benefits do not earn the delayed retirement credits. So you got two people here to consider in terms of how it all works out. Only one member of the couple can receive a spousal benefit at a time. Can't have both. And once you have opened your record, you cannot claim a spousal benefit unless it's bigger than your own benefit. And that's what I was talking about earlier, because they're going to look at what would you get as an individual and what would you get as a spouse and what's going to work in your best interest. But again, if you claim before your full retirement age, you're going to take a bit of a haircut. If you're divorced, you might be entitled to a spousal benefit as long as the marriage lasted 10 years or more. The person is receiving divorce spousal benefits is currently unmarried, so that person is currently unmarried. The ex-spouse is at least 62 years of age, so they have to be at least of the claiming age, okay? And if the divorce was more than 2 years ago, the ex-spouse does not need to have filed for benefits like we just spoke of earlier. In that scenario, the spouse did have to file to make it possible for the spousal benefit. In this scenario, the divorced spouse doesn't have that requirement, but they have to have been married 10 years or more. They have to be unmarried. And if they get remarried and they were collecting as an unmarried, then they will stop. I mean, that benefit will stop at that time. Here's an interesting thing. Some people don't know this, but more than one ex-spouse can receive benefits on the same worker's record. So I'll use my dad as an example. He's been married a couple times, okay? And my mom has already said to me, you know, one day when your dad, my parents are divorced, one day when your dad passes away, Nance, I wonder if his benefit is more than what I'm getting. And if it is, she could go into Social Security, call him, most likely right now because of the pandemic, and they would look at his record and they would look at her record and say, all right, what was he receiving as a benefit? Yes, you were married 10 years. You're not married today. Yes, you would be entitled to more because he certainly made much more than my mom did. My mom was a homemaker, so she was an example of either the spousal benefit or somebody that worked but certainly didn't have a real high income. So it can happen multiple times. So you could actually literally have 3, 4, 5 people claiming on the same record. That's also has contributed a little bit to the trust fund and the depletion of some of the monies out there for Social Security. Benefits paid to one ex-spouse do not affect those paid to the worker. I've had that question asked before. That's got nothing to do with it. They're totally independent. And the divorced spouse benefits do stop upon remarriage, which we mentioned. We're kind of coming in a little bit for a landing. We've got just a few more items here, and then we'll answer any questions. Claiming strategy, again, there's not as many out there, but there's still a few that we can help you with. They can be a little confusing. So whether it's Social Security that helps you or us that helps you get started, we're more than happy to do that. In 2015 is when they took off the most common one that people love to use, which was the file and suspend. It's gone. The only one that still remains is file restricted. And that would apply to a person that was born prior to 1954. They could file for their spousal benefit, and then they could allow their own benefit to grow. So I actually had somebody last week, and when I did the scenario, he did fit this criteria. He didn't want to exercise it, even though he would have made a little bit more money in the long run. He wanted to take his whole amount. So if the amount that he was working with as a spouse was 500 and his own benefit was 2,000, his point was, no, I want the $2,000. I don't want the $500 for the next 4 years. And even though his benefit of 2,000 was going to grow by 32%, he didn't want to exercise this option. But it is still an option if somebody has not claimed and they were born prior to January 2nd of 1954. And basically it is, you can claim your spouse's benefit, 50%, letting your own benefit grow and potentially having the 32%. And again, you don't have to wait till age 70. You could wait till 69 or 68 or whatever. It won't be long, and then this one will be gone as well. But there's still a few people that haven't claimed, because this person right here is already 67 years old. So they really only have the benefit of 3 years from 67 to 70. Here was an example of file restricted. I think right now I'm just going to keep going. Here were the survivor benefits. Basically, in a nutshell, it depends on when the deceased spouse originally claimed his or her benefit. So if they claim before their full retirement age, they were 62, 63, the benefit is going to be limited to the higher of the deceased spouse benefit, or 82.5% of the primary insurance amount. And again, I know a lot of numbers, a lot of things back and forth. Sometimes it just helps to see something with an illustration to be able to see how this plays out. But if he claimed after his full retirement and then passed away, the survivor benefit will include the delayed retirement credits, which is what we spoke of earlier. Those do apply. The survivor benefit, again, back to the age. The widow or widow, it depends on when he or she claims the benefit of the deceased spouse as to how much money they're going to get. The earliest they could claim would be age 60. So they do make a provision younger than 62 for a widow or a widower, but they're going to get a portion of the primary insurance amount, or they're going to wait. And some people have certainly done that as well. And they'll get 100% of the survivor benefit. Here was kind of an example here. The key here is to keep in mind that if both people are claiming in a husband and a wife situation, and one of them passes away, you don't get to keep both benefits. So one of them is going to go away. So in the case here, we had Joe, his benefit was $2,000, Julie's was $1,200. So let's say it was Joe that passed away. So Julie has to say, do I keep my $1,200? Well, of course not. Julie's going to need the $2,000 to live on, because she no longer has $3,200 a month to live on. Joe's no longer living with her. He has since passed on. Julie will then go in with a death certificate, and she will say, I need to claim my husband Joe's benefit, and that's called a survivor benefit. So they'll take away hers, and she will assume Joe's survivor benefit. The taxation, again, can be a little bit complicated. Basically, in a nutshell, it goes like this. Your Social Security taxes are not taxed in terms of your Michigan taxes. So there's no tax there from an income tax perspective. Potentially there is from a federal income tax perspective. When you're claiming Social Security, they issue a tax document. You give that to your accountant, or you're working with it. The long and short of it is, it's subject to this chart here, which has not been updated probably since the day it went into play, back in who knows when, the 30s or the 40s here. So it basically says this: they're going to look at your provisional income. Your provisional income is your adjusted gross income. They then take 1/2 of your Social Security benefit, which is on this tax document, and then they add any tax exempt interest. If you're married and filed jointly, and you can keep all those numbers below $32,000, you won't have any portion of your Social Security monies taxable. But as you can see with the increments there, if your income is over 44,000, and that's your provisional income, 85% of your Social Security benefits will be subject to your tax rate. So if you're at the 32% tax rate, 85% is going to be subject to the 32%. So it's not like you're paying all 85% of it back. It's just that you're going to take a piece of that pie. And again, in terms of calculations, what I found, and sometimes people do this too, they tell me, is Social Security has got some good examples even on their website. So I went out there and they have it under the IRS. You can just even Google out there and you can say, I want to figure out my Social Security benefits. And they will walk you through kind of a grid in terms of what you might potentially pay. But they have a worksheet called Figuring Your Taxable Benefits, and they give you really good examples so that you can kind of go back, or you ask your accountant and say, look, at where am I going to fall here? How's this going to work? Then they have 2 other increments there. You've got the single person who is still head of the household, qualifying as a widower, or the married person who wants to file separately. And last, we have the married couple who says we are filing separately, but we are still living together. And again, you can see the increments there. So if you at all can keep it under the amounts that are associated with 0, great. 32,000 for the married couple, 25,000 for the single. You don't have to think about, is any portion of my Social Security taxable? Otherwise you do. So that's the value of having a financial advisor. They should be helping you. My husband, as an advisor, has taken all of our monies and Social Security. I haven't turned mine on yet to say, look at Nance, this is what we need to do. So we've done a lot of Roth planning, because Roth planning is not subject to any of this. You can set this aside. So again, that's where your financial advisor can say, okay, I know what your goal is here. You're trying to keep it between 32 to 44, so only 50% is subject. Or maybe you can keep it below the $32,000. My husband has said most people that collect a pension in addition to their Social Security generally can't keep it at 0. They automatically are bumped into the 2nd or the 3rd category, because these are pretty low numbers when you think about it. So here's that provisional income: pensions, wages, interest, ordinary dividends, capital gains, and tax exempt interest. All of that, plus 50% of your Social Security benefit amount. And then it goes through these gyrations, like I say on this worksheet. Coming to an end. I love this woman here. Previously, I actually had music for everybody. I had 2 songs that we were going to play, but we're going to work on it for the next time. One song was going to be I Can't Get No Satisfaction. Remember the Rolling Stones, because many of you are boomers and you remember that music. And the other one was Sitting on the Edge of the Bay Dock, and all of the end of that. In fact, I got the name over here. What was the name of it? Sitting on the Dock. Anyway, we were playing that song early on. So that lady kind of reminds me of that. You know, the music in the background is playing and she's saying, peace, peace, you know.
Sitting on the dock of the bay.
Sitting on the dock of the bay. There we go. Okay, so here we go. Social Security, is it going to be there when you get ready? Most likely it will. They are starting to talk about in the year 2034 that they might only have 75% of the benefits to actually be paid. And then in the year 2089, we probably won't be here. I don't know what's going to happen after that. Hopefully our children, they're paying into Social Security today, are going to have something to fall back on. But this is serious. And I really hope that somebody says, you know what, we're really going to do something about it, because it is definitely a hot potato. I understand that. So here are some of the proposals. I mentioned the one in the middle right there, raising the normal retirement age. Another one might be the thresholds themselves. Today at 142.8, no more Social Security is taken out. We know people make more than that. Perhaps it should be subject to more Social Security taxes. The last one there is actually there's two more, lower the benefits for future retirees altogether. So what we see today of $2,000, maybe they only get $1,500. They'll redo that whole formula that I showed you earlier with those bend points. Or maybe there'll be no cost of living adjustments, period. They'll just completely do away with them. So those are some of the ideas. Key points. Remember, you claim early, you're going to keep it lower for the rest of your life. Your COLAs, they magnify the impact of all of these claiming scenarios because it does apply. Past couple of years, it was pretty minuscule. The decision to file impacts your survivor benefit. The longer you wait, the longer and more money that person. Now, you don't know who's going to pass away first. I acknowledge that. But if the male was the higher income earner, they would be the ones that would be leaving the higher benefit amount for the surviving spouse or the wife in this example, or vice versa. I think you get the general idea. What personnel can do at Social Security? They can help you estimate your benefits. There are a lot of calculators they have online. They can also tell you the amount you are entitled to. What they can't do is they can't project future benefits through any kind of scenario planning. They do not do that. They won't help you with file restricted. They won't run a scenario for you. They can't help with any of the other innovative strategies that might be out there. And again, there's not as many as there used to be, but sometimes people turn it on and then they turn it off as they go back to work. I mean, there's a few other things out there, but it's on a more exception basis. And I didn't think it was really appropriate to bring it up. I wanted to keep it more baseline level here for our audience tonight. In summary, certainly when you claim matters, the rules can be complicated. Combinations, they can work plus and minus. We saw individual, survivor. We saw X kind of benefits as well. And we saw spousal benefits. Some of you still might be able to do file restricted. The window is getting smaller and smaller. So by the time that person in 1954 turns age 70, it's gone. This particular scenario no longer exists. So it will go by the wayside along with file and suspend. If you want that expert advice, ask your financial advisor to help you, or we'll do it for a very small fee. Or if you're even an existing client of Ron Corser or Cornerstone Retirement Partners, we will do it for no charge. Some of you, it's pretty straightforward, and I really honestly don't have a big problem just doing it for you as long as you provide the information that I need. But generally, the fee is just a nominal amount to kind of cover my time and to cover the analysis. So you can certainly ask us about that. So that is the end of the presentation. Thank you for staying with me. Went over a little bit here in terms of our time.
We have some questions, Nancy.
Yes, please.
Okay, the first one is, well, first of all, thank you so much for the presentation this evening. I'm not sure it's really simple, though. I do think you still need a little bit of advice.
I think that's where the expert help comes into play.
One question is regarding the HSA in Medicare. If you are on Medicare, but your spouse is not, can they have an HSA account?
Is the HSA being considered in terms of contributions for both people or just for one?
Yes, we don't know that.
So I guess the way I would answer that is if
yes. She said, what about if you are covered on their insurance and they have an HSA? So you're on Medicare.
No, that's fine then. What I've had are married couples that are on the same group health insurance plan. So they're taking full advantage of all the maximization for the health savings account, and that negates the two of them. So as long as the person has an individual plan and they in no way, shape, or form Or if they're on a group plan, but they in no way, shape, or form are contributing, then they're fine. Because I don't know what the HSA numbers are, but the HSA numbers, you can't double them and do it that way. If only one person could be contributing, assuming they don't have A and or B.
Will Social Security be reduced by interest and dividends that you receive?
No. It only has to do with that last calculation, which has got to do with your year-end income taxes, and when you get ready to file them, they're going to look back at the interest and the income, but it's got nothing to do with your full retirement amount or your primary insurance amount, none of that. It's just got to do with whether any portion of your Social Security that you received might be subject to having taxation imposed on it through the regular taxation rules. You know, I mean, some people are at 28%, some people are at 30, 32. I don't know what all the thresholds are, but that's all it impacts is that.
I have another good one. If I'm divorced and I have been working, would I be able to claim on my ex-spouse's Social Security benefits or just on my own Social Security benefits?
So the person has to be unmarried, okay? And remember, it goes back to the 50% rule. So you'd have to find out whether your spouse made more money than you did by the 50%. So you'd really have to look at the numbers. So if your spouse had a benefit of $3,000, your ex-spouse had a benefit of $3,000 and your benefit was only $1,000, yes, you could go after the $1,500. But if your spouse has a benefit of $2,000 and your benefit is $1,500, no, you can't go after the spousal benefit and let yours grow because yours was not 50% more or less. So you got to apply the 50% rule first to know whether that makes sense or not.
Got it. Let's see. Also, people love your slides. If they put in the Q&A that they like the slides, could you send them to them? The
Absolutely.
PowerPoint?
Yes.
Let's see. There's a couple more.
Okay.
I plan to claim Social Security this October. I'll be 70, then retire the following spring in June.
So when he turns 70, he certainly wants to turn on his Social Security because there's no point in letting it go any further. So this, and I just did this for somebody not too long ago. She's like, well, what should I do? I'm turning 70. I said, take it. It's time to take it. There's no point. You will not accrue any additional delayed retirement credits. So what you do is you set up your Social Security account and you get online, or if you don't want to get online, you make an appointment with Social Security. If you do it online, you have to do it about 3 to 4 months in advance of when you want it to start. So if October is the 70-year-old, okay, I'm there. October is when I turn 70. You get in the system probably in July or August. It has a pull-down menu and it will say, what month do you want it to start? You are going to say, I want it to start in the month of October. That way you get the full 32%. The money is not deposited into your account because now you're going to give them a checking account. That's all part of getting it set up until the next month, which would be November. So you tell them, I want it to start in October. The monies are not deposited until the following month. And they deposit the money based on your last name. So I don't have the schedule here in front of me, but alphabetically, if your letters something through something, you get it the first week. If it's something through something, you get it through the second week. And that's about how they do that. And then it's pretty consistent. I always get it the second week. You go out to your account, you can see that it's been deposited in there, and then you're good to go. But that's how you would go about making sure at age 70, you get what's due you. They are running probably about 6 weeks behind in terms of their appointment scheduling, because I know people will tell me that when they come in about Medicare. So you're going to want to get on their docket, again, assuming that they don't open their office for a while here yet, and then set up an appointment. Is some people don't want to set up their Social Security account. That's fine. It can be a little challenging because they have a lot of levels of authentication now, which is good, so that they don't have hacking and so on. But it's also a little trickier to get everything set up. So they're more than happy to help you over the phone, but they will want an appointment, and then you'll walk through everything, and they'll ask you for your Social Security number and your mother's maiden name and, you know, were you ever married? And they pretty much take the ball and they'll help you through it.
Okay, great. My wife is already retired and claiming Social Security. We were told she can reclaim for 50% of my Social Security after I start claiming. Is that correct?
It's possible. And not without knowing the dates of when she first claimed, I can't answer that definitively. What I would tell you is probably if it was done within the last 2 years, the answer is no. But if it was done prior to that, the answer is yes.
Okay.
So they made a change probably about 2 years ago, where now when that happens, they look at both records at the same time. They look at the individual and they look at the spousal record at the same time. But people prior to a couple years ago, that is exactly what happens, is they went for their own benefit at 62 and they were told I could wait till I was 66 and then the government will adjust for the difference. So I could absolutely tell you yes or no, only if you told me when the wife claimed.
Okay.
So if you want to send me that information or call, then I'll plug it in again to my scenario. My software has all these rules that are built in. So that's why the age part and when you actually claim becomes important as to yes or no. But I'm going to say it's very possible, yes.
Is Social Security income taxed?
Is Social Security income
Is
tax?
it only through the calculation that I showed you. So at the very end of the presentation is where it potentially is taxed. But again, you have to go through to first figure out your provisional income to see whether you fall within those buckets. And if you do, a piece of it can be taxed. But the piece that is potentially subject to taxation goes into your income tax return, along with everything else that's subject to tax. So is it taxed up front? No. Now, some people will also, this is a good question, they will say, I want some of the taxes taken out now because I don't want to go through that and have to pay you anything at the end. So that's enough. There is a document that you can say, I do want some taxes taken out of my Social Security. It's probably a better question for your accountant than anything else. But otherwise, all I can really tell you is the full amount is not subject. No, it could be 85%, but it's not 85. It goes into the overall calculation for all of your income taxes. It's just one piece of the puzzle that goes into the income tax. That's why, again, whoever's asking that question, I'm more than happy to send you. I went out and queried publication 915. It's a IRS document, and it goes through all these scenarios. It says, you know, so-and-so is a single and he files this and he's got all this, and so-and-so is married and he's got, this is really hard to explain unless you have something in front of you. You know, it's hard to verbally explain it. So that's why what I always do is I go out there and I say, okay, federal government, show me exactly how this is supposed to work. And they go through a very good example. The person had a pension, the person had this, the person, how's it going to flow? So if somebody wants this, I'm more than happy to copy it for you and send it to you, and you can use this as kind of a guide.
And one final question. I have a healthcare savings program account. Is that an HSA?
Yes, that is an HSA. So the healthcare savings account is a use it or lose it. So every year, if you don't use it, the money's gone.
But that's not a health savings account.
Wait a minute, that's the other one. I'm sorry.
That's a flexible savings
That's the
account.
flexible spending account. I got him goofed up. You're right. The flexible spending account is use it or lose it. The HSA is another means of saving, which people do. So you can accumulate over the course of time. But yes, an HSA is what we were talking about in terms of Medicare, and you can't be on Part A and or Part B.
Well, I think that is all the questions we have for tonight.
So
I just
those-
put Nancy's email address. I put it in the chat.
Okay.
And in the follow-up, everyone who attends tonight will get a follow-up email, and that also will include Nancy's information. So
And
if-
then should I just send you the presentation then?
yeah, I can send it out to everyone who attended or whatever. I can give you
We
the
can work through
list.
the details on that. That's fine. You and I can talk about that. But yes, that would be great.
I just launched a poll on the effectiveness of our presentation. So before you leave, if you have a few seconds, really, there's only a few questions. That would be greatly appreciated because it helps us know if this was a great use of your time or not. Our next upcoming visiting expert will be on the warning signs of Alzheimer's. And again, we thank you all for coming tonight, and thank you, Nancy, for sharing your expertise.
Thank you very much, Chris. And thank you everyone else who participated. I wish I could see everybody's face, but one day, hopefully we'll be back in the classroom seeing each other face to face. So take care. Thank you.